Hello, everyone. On behalf of the Councils of Real Estate, it's a distinct privilege to welcome you to this session of What's Next for Real Estate and the Life Experience, Decoding the Economy, Mission Impossible, the sequel. Thank you for joining us. I'm Anthony Delapel, CRE, the first Vice Chair of the Councils of Real Estate and Managing Partner of the law firm McCurdy, Riskin, Olson & Delapel, New Jersey. The Councils of Real Estate is a distinguished international group of accomplished advisors solving the world's real estate challenges. Experienced, innovative, and credentialed problem solvers, counselors reside in 22 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation. I'd like to recognize our What's Next webinar series sponsors today: Altus Group, Busak Real Estate, Equus Capital Partners, and WPJ McCarthy & Company. Thank you all for your support. Before we begin, I'd like to offer you a free subscription to the Counselor's peer-reviewed professional journal, Real Estate Issues. If you don't already subscribe, please visit cre.org/REI to do so. You're encouraged to utilize the Q&A feature. Should you wish to submit a question, your participation is welcome, and we'll answer as many questions as time allows. I'm now privileged to introduce today's moderator, Will McIntosh, PhD, CRE, Global Head of Research of Affinius Capital, formerly USAA Real Estate and Square Mile Capital. Will is a member of the Counselors Economic Advisory Council, the esteemed group of American and European advisors from which you will hear today. Will's a past president of the American Real Estate Society and a fellow of the Hoyt Institute. He is the 2017 winner of the James A. Graskamp CRE Award, given by the Pension Real Estate Association for recognition of high-quality research in institutional investment in real estate. Will be introducing our panel. Welcome, Will, and thank you.
Yeah, thank you, Tony, and welcome, everyone. It's good to have everyone participating and to be back together with the counselors. As Tony said, we have a topic today that's near and dear to our hearts, and it's the sequel, if you will. We're going to talk about what's next for real estate, given the economic environment in which we currently find ourselves. And quite frankly, as we were discussing earlier amongst ourselves, it's anything but boring. So stay tuned. I think you'll find it interesting. I have with me today a very distinguished group of panelists, very accomplished, including Victor Kalanog, who is the Global Head of Research and Strategy for Real Estate Markets at Manulife Investment Management. James Costello, Chief Economist with MSCI Real Assets. Josh Harris, who's the Managing Partner with Lakemont Group. Hugh Kelly, who's the Principal with Hugh Kelly Real Estate Economics. Inga Schwartz, who is Head of Research Germany for BNP Paribas Real Estate. And Doug Kutas, Real Estate Consultant, who brings many years of experience in the real estate investment management industry. And finally, Melissa Reagan, who is Managing Director and Portfolio Manager with Nuveen Real Estate. And Melissa brings both the research background as well as the investment professional background of Portfolio Manager. So it's a great group. Over the next 60 minutes or so, we're going to discuss a number of questions that I think are on the minds of a lot of investors and managers, consultants in our industry. I have a few questions that I plan to ask our esteemed group of panelists. However, if you have questions along the way, please submit those questions. And as Tony said, we'll get to as many of them as time will permit. So with that, I'm going to turn to Victor here and ask what he thinks the economy is doing today and where he thinks it's headed. So Victor, please share your insights with us.
Thanks, Will. And since I now have global in my title, like you, I wanted to share some quick views about the world as a whole and where regions might be going. Our house view at Manulife is that world GDP will grow by around 2.5% this year. That's right between the World Bank's estimate of 1.7 and the IMF's 2.8. And those basis points matter for a world economy that's about $100 trillion large. For the US, we're looking at a 1 to 1.1% GDP growth rate. Baseline still not calling for a recession, although recession probabilities remain heightened. Eurozone area a bit weaker than that at around 0.8 to 0.9%. China between 5.5 to 5.7%, which for perspective is weak for that country. And Canada, because I now work for Manulife, is at 0.6%. So overall themes, most countries around the world are still looking at a shaky 2023 given various headwinds. But for perspective, things have been pretty shaky for about 15 months, haven't they? This US recession is probably the most forecasted recession ever, and it hasn't happened yet. And there's still a lot of panic out there, fueled pretty much by headline risks for the most part. A few days ago, the Wall Street Journal ran an article with the headline, Euro area enters into recession, but that's not the call of the financial press. That's the job of the CEPR and EABCBN in Europe and the NBER in the US. And Inga will keep me honest here if she could log on at some point. Sure, Germany's economy, the largest in the EU, is slowing down, but I don't think an official recession has been announced. The media tries to get around this by saying Germany entered a technical recession in early 2023 based on that 2 quarters of negative GDP growth rule of thumb. But newsflash, the US had 2 quarters of negative GDP growth in the first half of 2022, didn't it? But that didn't mean the US entered into a recession. So guess what? I'm still fence sitting here. I'm an economist after all. We're monitoring a lot of data points and making decisions accordingly, but that's the importance, I think, of having conversations like the one we're having right now. I want to hear what my colleagues who are in the front lines, closer to their markets, are thinking right now to help sift through real trends from noise. So let's bring it back to what's near and dear to our counselors of real estate hearts. Specifically, what am I most worried about for the real estate markets? I'm paying close attention to capital and credit markets in the US because of recent banking sector issues. And that's why I'm super eager to hear from Jim Costello of MSCI and what everyone else has to say. Back to you, Will.
Thank you, Victor. And does anyone want to jump in and add anything to that? I know that as I listened to Victor, you know, there's not 100% agreement on everything, but does anyone want to jump in and add anything to that?
I just want to observe that we've been talking about the yield curve inversion for I don't know the exact date it really started, but I know it was over a year ago because I think it was June. So happy birthday, yield curve inversion. And it's now at or just about, or it was about 100 basis points. So for all of those who've held that as a predictive quality or has a lot of measures, I think that is something, you know, for as much as the economy has remained in positive growth territory and, you know, that there's no way that does not create a lot of stress on corporate balance sheets who need to refinance. So I think that's a current factor and I don't know what that yield curve inversion was when we did the first one of these webinars, but it's worse. And I think that is something that we should probably bring back into the fold.
Estimates wise, 12 to 18 months after yield curve inversion, typical recession, right? So 15 months will put us at or around October, if you really want to be like super precise about it.
I think we also,
I just point out that most of our forecasting models run off equations that see the economy moving in some kind of a linear fashion. Even if that line is a cycle, we're in the midst of a disruption, which is a nonlinear event. And so things like the yield curve inversion, the other metrics that we have that feed models that are run by linear equations are weak at this point.
Well, it'll be interesting to see if Victor's right. If he calls it exactly, then we'll be defaulting to him from here on out for the future of the economy and implications for the real estate market. I was checking to see if Inga's been able to jump on with us. I wanted to see if she had some perspectives from Europe. Inga, are you on with us yet? Okay, it sounds like not. It's late in the day for her up there, so she could, or over there, so she could be tied up. Melissa, with sort of Victor's background here, give us a quick update on what you're seeing with the property market.
Yeah, thank you. Well, thank you, Victor. I think, the higher interest rate environment, unfortunately, might be here for a long time, longer than I ever really wanted or hoped for, but I think it's true. And so I think it's put, of course, property markets into a tailspin. We've all read the headlines. We all know, and I think Jim will talk about office later. I don't think that that's going to go away. I think we should be pretty prepared for the resting heart rate, so to speak, of, called a 10-year treasury to be in, probably around 3%, which is really high relative to where it was. And so I think that's going to create to Hugh's point, a really good, probably much needed disruption. It already has, I think we'll start to see it come through in kind of the corporate earnings that are going to start coming out. We've already seen it a little bit with some of the retail stocks earnings. Tech has been still really strong, but for property, I think it's yet to come. And so all the higher interest rate environment, the thinner those margins were on debt service, the worse and worse this issue becomes, particularly for something like office or where the cash flows are really constrained. That said, I think it'll be tough for all property types. And so, I've always been a big proponent of getting more into, the real estate alternative property types like storage or single family rentals or things that can kind of keep a little better pace with the higher debt service. But even those, I think all real estate, right, is going to, as long as rates stay really high, it's going to be tough. It'll be easier for property types that you can continue to increase cash flow. I do think as long as this goes on and the longer it takes real estate to actually reprice, so investors who run multi-asset portfolios, moving more into fixed income because the yields are so high, or moving into commercial mortgages because the yields are, that's much more attractive than real estate equity at this point. So the longer it takes for commercial real estate core or value add to reprice, the longer it's kind of going to take, right? That's just less and less capital that will be flowing into any of those sectors, and more capital flowing into fixed income or, commercial mortgages. So kind of almost exacerbating the problem. And then it'll really become a question of how does real estate kind of perform overall in this downturn, right? And then real estate investors, when we come through all of this, will say to themselves, how did it perform, right? In 5 years from now, how did it perform? And then what is the actual role it plays in my portfolio in a higher interest rate environment? Because the higher interest rate environment is new, right? I mean, bond yields have been falling for 40 years. So it's a newish thing for real estate. So it'll be interesting to see how real estate performs and then what the allocations are in 5 years from now to real estate, right? Because it'll be very telling as to how it performs in this next cycle.
Got it. Well, in talking to investors, the thought process is when you ask them what they want from real estate, they'll usually answer something like, well, I want current income, or I want total return, or I want diversification, or hey, it'd be nice if I could get an inflation hedge in here somewhere. And it's interesting to watch as this plays out to see how real estate is performing. And I think certainly people have been gravitating to industrial warehouse, and in part because it meets some of those needs, and certainly with e-commerce background, driving it has tended to perform well. People have been gravitating to apartments. The real elephant in the room has been office, and people worrying about the impact of COVID and work from home. I know, and I'll go ahead and open this can of worms, and you all can jump in here if you want. Right before I got on this call, I sat in on a valuation committee meeting and we were going over our quarterly valuations. And it's been interesting to watch how the benchmark has been valued, which in our industry tends to be, as you all know, tends to be Odyssey, which is the NCREIF open-end index fund index. And you know, they're still showing valuations in roughly in the high threes, when everything we're looking at suggests that maybe they're in the 4s, 5s, 6s, or 7s, or maybe even an 8, depending upon the property type, like office, the market, and the asset. So it's been very frustrating, I think, for some of the investors to be able to, you know, understand how these valuations are working. But it's been tricky. Any other thoughts about the property types? Doug?
I'm just going to jump in and say that, you know, I respect Melissa tremendously, but I'm an old guy, and to me, rates aren't high. 3% is not high. I started peripherally in this industry in 1980. You was there at that point. You're a client way back then, and you know, you wouldn't have even imagined that we could ever have a 3% 10-year treasury. You know, the 50s were long gone and we were dealing with double-digit treasuries. And, you know, when I jumped into the investment management side in 1991, I remember the basic cap rate was a 9. And, you know, could it go as low as a 7 for a really good property type? So, you know, we've had this crazy period of time when money was free. And I think people mistook a transitory situation for a permanent situation. And the biggest mistake they made was they mismatched assets and liabilities for, I don't know, the 10th time in the last 40 years. And they borrowed with short-term money with real estate that's almost always a long duration asset. And I see these headlines that are blaming the office market not returning to office for the fact that some of the biggest names in real estate have defaulted on their mezzanine debt that's on top of their first mortgage debt that added up to 80% of the value when the property was valued at a 3. And they defaulted only because they floated the debt and didn't even buy hedges. It just blows my mind how we can be continuing to mismatch assets and liabilities, duration left and right, and what goes along comes along. It's every 10 years we have a major crisis. One wasn't really our fault, the dot-com one. The others were places where we got way out ahead of ourselves.
Well,
in
maybe
each of the cycles.
I think, yeah, certainly agree. I think I think it'll be interesting. Maybe it'll wash it. Listen, it could be a real benefit, right? I mean, think about, and Victor, you may have some ideas on this, right? Like there's some crazy stat, like 14% of all companies in S&P right now are like zombie companies, right? Like they really don't have enough cash flow to be able to pay debt service. And I think same thing happening in real estate. So you get kind of the zombie companies washed out. And then, you know, in real estate, you get maybe some more discipline or people being smarter, to your point, Doug, and how these assets are managed, B, financed, and maybe it could be a really good thing, right? To kind of have the cleansing, so to speak.
Well, you know, Melissa, I think one of the, as you're saying that, I can't help think about, as you know, certainly for all the counselors and all those on watching this, that the need for like actual asset level and market level expertise has probably never been higher, because I mean, this is a stock picker's environment. Like every individual property has to be viewed. In fact, the office marketing, this one drives me, I mean, a little bit nuts how much there's sort of like this broad approach to sort of like broad brushing something, to where we know that this is going to be very asset by asset. So like, you know, in New York City, you know, I'm sure the assets that are quick walkable to like Grand Central and Penn are going to look phenomenal. And then if you're, you know, many train stops away, it could be a whole different story. And I think in every single market and even sub-market, it's going to be something similar. So, you know, I truly think that asset management will maybe be the exciting watchword again, and that actually, being a little bit more tactical. And to no offense to anybody in here, because probably a lot of us have been in asset allocation decision making, and then it's just go, hey, look, here's a mandate, acquisition officers fulfill it. But I think that actually doing the grunt work and the elbow grease is really what's going to mean for it. And look, it may not be as great for the investors, but it probably is good for the practitioners, and that's kind of what happens in these cycles.
Josh, sort of related to that, Josh, we got a question from the audience that's asking about what the implications of the current environment is for CapEx on efficiency and decarbonization projects.
Well, that's the big challenge in some of these assets, because you have some office buildings where there will be enough revenue to be able to cover the new mandates that are in place for those. But then there are others where that's just not going to be able to happen. And so you've got, a variety of assets that may be livable moving forward. Livable meaning they can be surviving in the current hands of the current owners at a reasonable price level. But others, just that CapEx need may be insurmountable unless someone's willing to take a big loss. And that's a huge area of inquiry in sort of this real estate information space, with everybody trying to, it's almost a wild west of every information provider trying to come up with the right widgets to provide solutions for that. It's kind of like the early 1980s when you had FW Dodge and Cognetics, Torta Wheaton, all trying to get real estate information on the commercial sector together. It's the same kind of rush to get the right model today.
Got it. I'm going to circle back to Victor. I think we heard from Inga. She was trying to get in, but she sent some thoughts over that she wanted to share with the folks in the meeting here. So Victor, why don't you give us what Inga was saying?
Okay, I'll share what Inga sent along, but aber nicht auf Deutsch because my German is not that good. Pretty similar trend, 60% decline in transaction volume Q1 over Q1 in the EU area. She's expecting about a 1% growth rate for the EU economies for 2023, while acknowledging that some markets like Germany did enter a quote-unquote technical recession. She's also seemingly hopeful that the latter half of the year will experience some positive growth. For office in Germany, down 66% year over year. So no surprise, very similar trends. And I do think it's not going to be, I like what you wrote about it not being a state secret. This is Q1 over Q1, that Q2 does not look much better. And so a lot of things, I think a lot of deals kind of being paused right now because of this price discovery that Doug and Jim and Melissa have all been kind of intimating. I also am wondering if in retrospect through the cycle, 5 to 10 years from now, we look back and think, wow, this is actually the time of high disruption where we could have picked up assets for cents on the dollar. Who knows? Maybe. Like with all this distress, will there be much more pressure on the repricing front? Josh, what do you think?
Well, I think,
yep.
Yeah, I mean, one of the things that, in the last, and this is a little bit of a scary thought. And actually, Jim and I where I was moderating a panel with a NAIOP event, and one of our panelists, this is earlier this month, sort of said, well, the reference period should be the late 80s, early 90s. And, I'll casually admit I'm not old enough. I mean, I was alive for that, but I certainly don't remember the banking crisis or can say I can live through the industry side of it. But, one of the things that, so for me, the 2008 crisis was the defining period. That's why I went and got a PhD, kind of saw that coming, and, it ended up being good timing as it would be. But, we had falling interest rates. We had a lot of capital. I mean, I had observed that, and I was in Florida, and I'm down back in Florida, and it was like $10 for every, it's like for every $1 of distressed assets that came to market, that felt like there was $10 chasing it. Now we're in a period where the interest rate cycle has reversed itself and CapEx. So, will the question that I think I'd love to get, I don't know who will answer it, but anybody on here who thinks they have an answer, are banks going to sell at a discount? Because they didn't really do that in 08, 09 unless they were really forced to do it, like a busted condo deal or something. but are they going to sit there and asset manage the way they did through 08, 09, and sort of that helped stabilize the market tremendously? Are they going to put CapEx out? Because I think it's been said a million times, like that to me is the big question. And there is a chance that the banks might have to truly, let things go because they need a new investor to put CapEx in a way that didn't happen through 08, 09. I'm curious what people think the implications are.
Josh,
Usually, who wants to take a loss, right? And so you're going to delay making those decisions until you're forced to, in the
Right.
hopes maybe things turn around and you can come back. So everybody's been hoping and waiting for distress to come. And it just hasn't materialized yet because all those kind of behavioral things still have to play out before people have that come to Jesus moment with their lender. And but when that finally happens, I think it's going to vary by property type because of this issue about what will the future income stream for that building look like? What's the expectation for it? Trying to put a lot of CapEx into an office building that someone has returned to the lender, they have to think about, am I just putting good money after bad? That's the concern they'll have. So I wouldn't be surprised if you get a behavioral difference in terms of how they act with offices, certain types of retail versus apartments and industrial. And what Melissa was describing, I like to categorize kind of demographic-driven property sectors and sort of the self-storage and the others, where the demand elements are a little bit more predictable.
yeah. Well, Jim, you guys bring up the question of distress. I know there's a lot of people talking about distress in the market. Is it going to happen? When is it going to happen? And I know it's not really showing up in a lot of the data yet, but I can tell you that in talking to our debt team, particularly our debt team that works on distressed projects, I can tell you that it's starting to happen. It's happening very quietly. The phone calls are occurring, the discussions are occurring, and so stay tuned. It's about to filter through the system.
It's happening. It's not like it doesn't happen immediately. It's not like you have a challenge in the economy and everything works through. It takes time, but that potential distress, delinquencies, that kind of stuff is growing. The pipeline is getting ready, and then they're going to have to move through it. And I apologize for the fact that I'm zooming in and out. It's not that the cameraman is drunk. It's just that Zoom wouldn't work with the camera on my laptop. I mean, you'd see only my jacket and my pocket square. Maybe you'd prefer to see that, not my face. But this I thought I could get my face, but now it's like zooming in and out.
It's very dynamic, Jim. It's very
I
dynamic.
think it adds a great element, Jim. It really spices up the this call. Love it.
Well, I'd like to follow up on some of Doug's comments, because I think they tie into this issue. First of all, Doug, thank you for noting that you joined me as someone who has gone from being a young Turk to an elder, although I'm more elder, turning 75 on my next birthday, right? But I actually want to make a distinction between those whose training has been in the financial management of rapidly changing markets, and those who have developed over the course of a career an ability to look at long-lived assets with some perspective. If there's a book that I would suggest that everyone read, it's John Kenneth Galbraith's A Short History of Financial Euphoria, which says this has been recurrent since the 16th century. I place a considerable amount of blame on the way we train our financial managers, and I think the universities, and I obviously having a long tenure at NYU and at Fordham, bears some responsibility here in training overly technical and short time horizon decision making versus managers that have been through things, and who recognize that over time, we can work through problems. We don't have to have a knee-jerk reaction. And I think that's something to be considered in the way we manage stress. Actually, I see the 2009-2010 learning as being a positive learning, as opposed to the 90s and the around 9/11 disruptions. In those early disruptions, both lenders and equity took a short-term perspective and altered their positions to reflect transient conditions. Whereas in the 2009-2010, the idea was, are we better off with going through our assets, seeing which ones have staying power and which ones don't? And I think that's something that our business schools do a very, very poor job of evaluating. We train for technique, and we don't train for judgment. That's my perspective, kind of linking up Doug's comments to what Josh was saying. And
but
Will was
Hugh,
saying.
you know what, Hugh, I don't think it's all, so I don't think it's all business schools or your fault, like at all. I mean, think about this comment, going back to Doug's comment on the interest rates, right? So if you had bought, a property, you're going to hold it for 5 years, you put all this floating rate debt on it, and you never underwrote, then interest rates were going to, if that was never a scenario you ran, like, I mean, come on, like this is pretty basic, right? It's like, or you assumed rents were going to, go to the sky forever, or you assumed you're going to exit at a 5% cap rate, and that was always going to be the case, and you never ran a scenario. Well, hey, what if interest rates really are 5% forever? What does that do to my, and like some of this stuff is just like basic, and so it's not your fault, Hugh. Like, I mean,
it is a little bit.
Well, I have to say though, Melissa,
like, come on, right?
This is.
Will
Josh is
was the
about to
dean of a
jump through the
business school.
screen.
Will was the dean of a business school.
We'll blame Will then. But here's the thing that we are also, and look, I don't know if I'll take blame or credit for being in the academic system or not, but when everybody in real estate sort of started with either brokerage or appraisal, you were forced to look at the asset first, and you knew what a lease rate was because you had to actually negotiate one of them, or had to read the lease to value it or whatever it is. Today's world, and look, I can tell you, every kid I taught at NYU or any other place, they all want to go to work for Blackstone, BlackRock, or Goldman Sachs, and they come to real estate starting at a spreadsheet and looking at blips on a screen, and and these are and look, the data that comes off of RCA and MS, and Reese and all these great systems, but it's property level stuff. And I think that one of the things that this industry lacks from is that people don't get ground level, property level experience. In fact, it's not even considered prestigious by the students. So realizing that like one office building could be in a totally different position, like there's not even a basis of understanding because it's so foreign. And I think that that's one of the things that has to change. And I do think that's why when so many people are acting so fearfully is that because they've been buying these assets, they've got billions of assets under management, but they don't really are connected to them on a way other than, well, what a cool picture and a tour, right? And I think that is probably when that gets met, I think people actually be less afraid of it. Actually, I think you'd see a lot more opportunistic buying even today if people actually understood physical, what do they call it, the bricks and sticks, right? And I think that's part of the issue that has to probably shake out.
So Josh, go ahead, Jim.
The folks who understand the sticks and bricks. It's not the folks that bought the distressed assets after the financial crisis, which was a distress of just bad debt and a leverage that was too high. It's not that private equity buyer coming in for the small amount of distress we've seen realized so far. it's the local developer, owner, operators, it's the folks who can swing a friggin' hammer. Those are the folks who are buying the distressed assets so far, because the nature of distress we're seeing is differently. It's a distress on the fundamentals. And it's going to take somebody who understands real estate and can actually reposition a building because they know how to work with the local development board and get past all the NIMBYs who want to keep everything exactly the same as before. So the nature of distress varies by cycle as well.
So we got a question from the audience wanting to know how many of the economists here on the on the panel are actually working from home or in their office. So I gotta ask.
Well,
Josh, you
that-
working from home?
We're working from home.
Yeah, I'm in the office. Doug,
I don't have an office. I'm semi-retired.
yeah, okay.
I have
You're
a
in the home
client. I have a
office.
client in London and a client in San Francisco, in California. I don't go there either.
All right, and you're at home?
I'm working from home, but twice in the last month, I've had clients that have asked me to come to them.
Okay, and Victor, are you in the office yet?
I intended to be in our Toronto HQ, but apparently the United CEO said it's the FAA's fault that 4,000 flights were canceled this week. So if intentions count versus outcome, I would have been in the office today.
And Melissa, are you in the office?
I'm in a hotel room in Denver, traveling, looking at the sticks and bricks.
Close enough,
Yesterday and
close
today,
enough.
so, yes,
And Jim, I'm betting you're in the office because your camera is suggesting that you are.
Well, it's whenever I'm not traveling, I am in the office, and that's not. And there's a reason for that. You know, I think the need for office space is changing. There still will be a remnant of demand that will persist into the future, and it's for folks who, in the course of their jobs, they have to develop and spend social capital, meaning high touch kind of jobs where it's a lot of client interactions, a lot of thought, knowledge sector workers integrating with folks directly. I leverage our New York office location when I'm on the ground and not in the plane, not like, off in Denver or Toronto, like Victor or Melissa, to just get out and about in the city and see people. So I've got 2 meetings today, just walking nearby to see people in the investment world who are also nearby, just that benefit of clustering. And that kind of stuff helps, I think, generate some element of office demand moving forward. That's not to say that, in the winter, I won't be down near Josh in my winter home on Fridays. But it's a different life cycle kind of thing starting there. But the other issue for me got down to, like, I spent so much time in my apartment during the COVID crisis that I need to buy a new couch. And I figure from this point moving forward, I'll let the company take the depreciation of the furniture.
Got it. So where do you think, and you may have already addressed this in some of your comments, but I want to make sure we're clear. Where do you think values are going, generally speaking, in the office sector? Because we're, people are debating what the write down should be. Is it 10%, 20? Is it 15? Is it 40?
Sure.
Yeah.
There's a couple different elements to what drives the reduction in prices, and the prices are falling. You have all the issues we were talking about earlier about the changes in the interest rate environment and how you can finance stuff, and the reduction in leverage and the increase in interest rates. That has one impact. Even if everything else wasn't happening, that would have an impact on asset values. And then you have this looming recession that people are worried about. And even if we weren't worried about back to the office in the future, just a looming recession would make people more cautious in terms of what they're going to underwrite for an asset, because they're worried about just that shock to income growth there. And then there's a structural change underway in the office sector on how the space gets used. You line all those up, and you can get a lot of variation in prices just based on how individual properties fit into those kind of metrics. So like the CBD office locations are one of the poster child for the challenges that the office market faces, because it is expensive for people to come into the city. It's a pain for workers to come in, and that becomes an issue in terms of you'd have to pay them more to get them in, and firms don't want to pay more. So you have that kind of an issue, and then you have safety issues and cleanliness and all that. So the CBD office locations are important to think about in that framework. Manhattan, prices are down currently when you control for the quality differences of buildings. Prices are down 26% from the peak in 2017. And that's the market overall. But then some buildings are doing a bit better. Like we saw a notable distress sale last year, 245 Park, and it just sold from that buyer of the distressed interest to a final owner, and it was only about an 11% decline in value there. So even though the market is down in total, that one was about an 11% haircut because of location issues are a bit better. Right near Grand Central Terminal, just the location benefits were good. So there could be big variation. An older building that's going to require a ton of capex at a higher interest rate environment, that may not get that price, that same kind of price. So it's, longer term, I think places like New York still have a need. Again, it's for social capital kind of stuff. Where I'm more worried about is commodity suburban office, because if your only justification is that it's a low cost location, well, guess what? Tampa's not the low cost location anymore. Mumbai, Monterey, the Philippines, those are the low cost locations. Commodity office space in those areas, they need another purpose.
Let me look back to Hugh, and Hugh, I know you have given a lot of thought to urban real estate, and particularly when we think about the fact that we've been through a pandemic, and a lot of people were worried about what's that going to mean for the cities and all this urban real estate that we own. Hugh, what do you see as the impact on the urban real estate going forward?
So thanks. I have been giving this some thought, and to keep myself on track, I've reduced it to 5 points. So I'll just tick through them. But before I get my preview is on Jim's comment about 245 Park. I remember 245 Park sold in the end of the 70s for $30 a square foot. It sold for $30 a square foot. So gives us some longer range perspective, right? So here are the 5 things. 1, it's a fundamental question as to whether the pandemic has triggered a cascading effect across the property markets, or whether we're in a period of temporary adjustment. I think that's an open question. Right now, I'd say the jury is still out. But it's clear that adjustments across the urban economies falls along a spectrum. Hence, Jim's comment about commodity space, right? So as always, investors and real estate professionals need to pay attention to details and be selective in what they do. That's the discipline. Number 2, I'd caution that despite the flow of stories about the doom cycle of cities, I don't see a vector break in the trend of urbanization. That's true in the United States. The last census data that we have says that 83% of the US population dwells in MSAs. And that's up from 75% in 1990. It's up from 89% in 2000. It's up from 81% in 2010. The COVID phenomenon did not break that vector. We don't have any evidence of that, but it has changed across cities. Of the 20 largest metros in the areas, 10 gained population between 20 and 22, 10 lost. So there's a mixed bag there. New York, San Francisco, Chicago, LA have grabbed the headlines because they've lost population, right? And that's driven the narrative. Although I will say that Manhattan's population in the last census estimate is up. And I just ran an affordable housing conference in Brooklyn. And the problem there is not lack of demand, it's lack of supply. And it's a lack of affordability. You know, so that's important too. But major markets, including Houston, including Atlanta, including Seattle, including Denver, including Miami, are gaining population. So that has an important effect on the overall demand profile, I think, that we see. Of the top 40 MSAs, to expand it out, 23 have lost population, 17 have gained. So it's a near thing. But if you go down the scale of cities to the bottom 40 MSAs, 25 of them have lost population, only 15 have gained. And so size matters. Size matters for investors because it gives you more choice, right? You have more choice in terms of quality, but you also have more of this agglomeration effect effective in the large areas. That's important. From an economic perspective, the US economy is driven by its cities. 88% of our GDP comes from our metropolitan areas, right? And of that, 45% have come from only the 21 cities that I look at as either 24-hour cities, 18-hour cities, or 9-to-5 cities. And of them, 21% of all GDP is in the 7 24-hour cities. And another 16% are in the large 9-to-5 cities. In the 18-hour cities, the Austins, the Charlottes, the Nashvilles, you only get 8% of the GDP, which is remarkable. They're growing fast, but their base is low, and they're not that important to the US economy. And if you look at the productivity across the areas, that is to say GDP by worker, for the US as a whole, it's about $130,000. For the 24-hour cities, it's about $150,000. For the 9-to-5 cities, the larger ones, it's about 143,000, significantly higher, and for the 18-hour cities, 138,000. So it's important because productivity is what supports incomes. It's the output per worker that supports incomes. And it's also what pays, what generates corporate profits and therefore pays the rent. And so watching for productivity is important. So that's my fourth point. And the fifth one is following on some of Jim's data. If you look at what MSCI tracks in terms of transactions, for the 4 quarters ending the first quarter this year, the 7 metro areas that I characterize as 24-hour cities represents $10.6 billion in deals. The 9, that is to say, above, that's nearly 25% of the total. That's above their share of employment. It's above their share of GDP. Likewise for the 9-to-5 cities. So the big cities are punching above their weight economically. They're still punching above their weight economically. So whether this continues remains to be seen. I don't think that this is a done deal, but I think it's contrary to the narrative that we're hearing.
Hugh, let me just interject real quick in something that's likely on top of a bunch of real estate investors' minds and city dwellers, right? To your point, a lot of these are backward-looking statistics, but the media is replete with headlines about, oh, folks still don't feel safe taking transit. Crime rate is up. Is it really? I'm not sure if we've actually taken a look at CompStat statistics from the FBI for property crime. So what's everyone's take on this whole, was there not an article that usually includes the terms doom loops, right?
Yep,
So on.
just
like,
out.
Josh, you're laughing. Whatever. What's your take on it? Like, is there an inflection point? Is there hysteresis because COVID's gone, but we still don't like to take trains? I don't know.
I think the two, I want to make a It's not really. I actually agree with both of what you said, but I'd just say a possible point of explanation on some of the data when it comes to how when you have these dispersed networks of workers, which I think we're all increasingly part of, that, with when you have people that are residing in one market, but perhaps they're tied to a headquarters, especially when you're talking about knowledge work. It's easy with a factory to measure where the widget came in, the widget went out, but with knowledge work, it's crazy. And I remember meeting attorneys, and back when I was, much younger in Orlando, where have these discussions. Oh, what do you do? You do, oh, I work for a hedge fund. Like, hedge funds in Orlando? I've never heard of such a thing. Oh no, I'm actually technically in the Greenwich office, but it's cheaper to hire associate attorneys in Orlando and build up at the Greenwich rate. So I do think that there is the effect of this is going to make a lot of these locality-based statistics way crazier, right? I mean, if you offsource stuff to Mumbai, I think that's a pretty example, but then your point of sale is San Francisco. Well, where exactly did that creation occur? And to Victor's question, I do listen, and I recently personally made a decision to locate my family in Orlando, Florida versus New York, because I had the ability to do this. And look, there's a quality of life effect, and I think that for me, there's family and other attachments here, so it's not quite just like I picked it off of a map. But
Are you a Disney guy? Are you a Disney?
No, actually, no. But I have younger
Sorry.
children. I do have younger children, so I might become one. In fact, I probably will be, but definitely wasn't. Definitely, in fact, I wanted to avoid that part of town as much as I could, in all honesty. But there is a quality. I have to say, from a quality of life, a standard of living. When you have cities that have very accessible airports, I think places like Denver, even Tampa, and certainly Orlando, and I think Charlotte, there is an ability to diversify, and that's something that I remember a discussion. In fact, I remember a presentation that Will McIntosh gave when I was at University of Central Florida in Orlando, and when I was asked the question about, I think he knows where I'm going with this, where does Orlando fit? And there was this theory that, well, when it hits, when the proverbial stuff hits the fan, you can kind of count on New York and San Francisco holding in, but Tampa and Phoenix falling apart. Well, and I think Will and I had a follow-up discussion in the midst of the pandemic, and suddenly that little paradigm doesn't play as well. And I think that I do think that, and I've seen this in other presentations where Europe has more cities that are more diverse. I do think that the top 10 list that like Hube's 24-hour list, I think that it doesn't mean that we get down to city ranked 80 and 60 through 80 are going to have maybe that much of a difference. But I do think that the top 25, which does include the Orlandos and Tampas and all those, is probably more equivalent from a power base, from a knowledge network, because of this remote ability. So I don't know if that's a big shift or not, but I think you even said that, right? Top 10 losing, another 10 gaining. I think that's probably historic.
And here's something that I think has not been well considered. We look at the easily accessible information, right? And don't make too many good observations of on the ground change. So it's true, Phoenix and Tampa have gained a lot. But if you consider the Phoenix of 20 years ago and the Tampa of 20 years ago and those cities today, they have not changed. They've just gotten bigger. They've not changed. They're the same thing. The cities that have changed are the 9 to 5 cities who have adopted deliberately some of the 24-hour strategies.
Like a Seattle?
I think Houston.
Okay.
Houston's downtown. I think LA's Bunker Hill, Disney Center to Staples Center area. I think Midtown Atlanta, which is a very complex and lively. I think of Lodo in Denver, right? Those have not only gotten bigger, they've gotten different. And I think that's something I want to explore and just to make a promise to everybody, I want to look at that over the summer, and by the end of the year have something in real estate issues about what I find.
But there still is a challenge, even in cities like that, Hugh, of some of the social chaos that has been happening in urban America. And it's not just, it's Orlando as well. a good friend that Josh and I have told me about the problems where he was having dinner with a client in downtown Orlando, and some meth heads came up and started stealing food off of his plate, then hitting each other with the plates. A chaos like he had never seen in New York. There's these challenges that just are not going addressed.
Well, was it good food, Jim?
What's that?
Was it
good food?
Well, who knows? Who knows? It certainly wasn't afterwards. But those social chaos issues, whether, I don't feel them, but maybe that's because I'm a big white guy, nobody messes with me, but somebody like a smaller Asian woman may not feel as safe, just given some of the nonsense that's been floating around out there. So the preferences that people have may be different in every city, but some of those issues, you mentioned the particular neighborhoods in LA, but if you get over towards Skid Row, that is a shame on America that we have people living in streets in such squalor, and some of those issues need to get addressed to make these cities livable. I ran into Mayor Adams here in New York in the elevator of my building here in 7 World Trade. That's, again, the kind of thing you get in the city. And I thought to myself, I'm going to meet the mayor. And I waited for him to come out of the elevator. And his security guys were a bit cautious, but I was wearing a suit and tie, so he said hello. And I told him, hey, real estate community here in New York, they're worried about crime and everything. Everyone I talk to, they want you to keep focusing that, get these social chaos things under control. I don't know exactly how that impacts prices. I don't know how real it is, but there's a perception that it's there. But if they can deal with those issues, then it allows the property owners to think about other things like, okay, how should I finance this? Because if you have that other uncertainty out there that's beyond your control, that makes the pricing even scarier.
And to pick on Josh and Orlando again, it is true. You're right. Just driving down underneath that bridge by the Marriott downtown I-4, right?
I know what you're talking about. Yeah.
At night, you just don't walk. A good thing
Yeah,
most folks drive in Orlando, but
there is a point that, and this is a thing about when compared to New York, for all the cities like the size of Orlando, which is many, that area of downtown, and I know the exact hotel you're talking about, it is such a tiny portion of the city and the communities that you don't have to drive more than 2 minutes and you're away from that. And the thing about New York, and this is with the subways, that it's hard to escape. And I mean, I felt probably more isolated. I lived in New Rochelle up in Westchester. It was harder to get around, and I felt I had fewer options from a practical standpoint of where to go to dinner because of how long it would take to commute, the trouble it was, even though there's a million more options by the map than I do, say, in a place like Orlando. So it's like, and you're right, the way that people feel about the downtown core, I can drive literally 2 minutes. And I mean, I don't live in the downtown core. So it's like, oh, that's an interesting story. I wonder which restaurant. I don't know. It wouldn't even affect anything. And I think that 30-minute drive time radius thing that you get in like San Antonio, I'm sure you're right. Like Will can go to probably any place he wants in San Antonio just as feasibly as anything else. And that's a difference that's the cost of the commuting troubles that you get in a big city. And that,
the challenge.
Guys, I got to interrupt here for the sake of time. We're about to run out here. There was one question that I thought was kind of interesting. A question from the audience. They ask, so given everything we've said about the economy and real estate market conditions, is anyone forecasting or suggesting that we should be underwriting exit cap rates at levels below where current going in cap rates are? Any thoughts on that?
At your own peril.
Yeah, exactly. At your own peril. You never did that.
That's
You
right.
never did that when the cap rate was 9. You
All
had
right.
it at 9.5.
How bad do you want to do
6.
that deal? Do you really want to do that deal?
Right.
Yeah.
Can I just say, though, that one of the parts of my long lesson is the easiest investment committees to say yes at usually turn out to be the worst deals you do. And the most difficult investment committees to say yes at, my history, have turned out to be the best deals. It's just
Great point, Doug. With that, we're about out of time here. I just want to thank everybody. I want to particularly thank, obviously, the panelists for taking time out of your busy schedules to jump on here. I know everybody's, given where we are with the economy and real estate markets, everybody's busy worrying about what we need to do next. I want to thank Bill and Tony and the CRE staff for supporting the webinar. And I definitely want to thank the audience for jumping in. There wasn't a lot of questions, but there were some good questions, and we appreciate that very much. And I'm going to turn it over to Tony for his closing remarks.
Thank you, Will, and thanks to all of our stellar Economic Advisory Council members. You each exemplify the exceptional thought leadership for which the Council's Real Estate is known. I'm going to suggest to you that these topics are of importance to us, not just now, but in the future, and invite you to consider submitting articles for real estate issues on anything related to these topics that you might want to write about. And the only other thing I thought I'd offer before we close is I'm not an economist, but I counsel people on real estate investments and real estate development and redevelopment deals all the time. And one of the things that strikes me about your comments is that the investment community and development community, at least in the Northeast, is still somewhat bullish because they think that there are deals to be gotten. And one of the things that I think underlays a lot of the common thought that I've heard about in the past 12 months is that people aren't running away from cities permanently. They might have temporarily left them, but there's a reason why cities were developed in the first place. You know, it has to do with location, has to do with geography, has to do with access to transportation, access to labor, education, resources, and quality of life obviously is important. I like Josh's comment because I have a daughter and son-in-law who live in Denver but work in New York, so it hits home with me. So are the cities going to end, or are they just going to be remade is really the question. And I think Yu's comments really focused in on some of those other demographic issues as well. So this is a great panel. I thank you all. I want to announce to our audience that on-demand recordings are available for most What's Next sessions. Please look for announcements on upcoming sessions this summer. Until then, on behalf of the Council's Real Estate, thank you all for attending this session of What's Next for Real Estate and the Life Experience.